In this video, we're going to look at Transatlantic Petroleum, and this is an oil and gas E&P company. E&P stands for Exploration and Production, which is the early stage of the energy production process. It includes the searching and extracting of oil and gas. What I do in my videos is I run my discounted cash flow model to figure out the intrinsic value of a company's stock, and then look at their financial ratios and compare them with their competitors. I do this with you throughout the entire process, so it's like we're doing it together. Let's get started with the model. This company went up 56% today. That's kind of crazy, right? The market cap is $34.8 million. And they're trading at 49 cents. So 2 shares is under $1. Next, we're going to pull the free cash flow. And the way you value a company is you estimate the future free cash flow, and then you discount that number back to today. And that's exactly what I'm doing in the video. And free cash flow is a cash flow after operations minus capital expenditures. Now I'm going to pull the net income, which is the profit and loss on the income statement. Now I'm going to pull the revenue, which are the sales for each year. So there's a lot of negatives here. They have negative net income every year, which does make it a little harder to value the company, but I think we can get a good value because they do have positive free cash flow each year. Let's look at their capital structure. Let's see how much debt they have. We'll go to the balance sheet. And then the current debt is $17 million. And that's debt due within 12 months. And the long-term debt is $2.9 million. That's debt due after 12 months. So the cost of debt is 4%. To get the cost of equity, we need the beta. The beta is how volatile a stock is relative to the market. And have a beta of 1.31. So the stock is a little more volatile than the market. So let's go back to the balance sheet. We need some more information. We need the current assets. We need this to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And that's $44 million. Let's get their current liabilities. These are debts and payables that are due within 12 months. That's $42 million. And their equity, that's assets minus liabilities. That's the value of the company according to the balance sheet. That's $7.6 million. Now we need the EBIT, earnings before interest and taxes. That's called operating income on the income statement, and that's $18.8 million. Let's look at their capital structure. The cost of debt is 4%, and they have 73% debt. The cost of equity is 12.4%, and they have 27% equity. So the weighted average cost of capital is 6.3%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $155 million. We divide that by 71 million shares, and we get an intrinsic stock price of $218. They're trading at 49 cents, so they're trading at a 77% discount, so it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're way higher at $28. If you hit the View Data button, you can see how Simply Wall Street got its numbers. And they pretty much pull analyst estimates, and I think that's how they get all their numbers. So you can see the 2021 free cash flow, $38 million, and then they discounted it to $35 million. And I'm a little lower at $31.27. And then they go up to $60 million, then $84 million, then $108 million. They're growing the free cash flow a lot faster than I am. I am using a more conservative model because my other models didn't really give me much of a value for the company because there's so many negatives. But this model does give me a value, although it assumes a larger growth than they've been doing in the past. But Simply Wall Street is assuming even greater growth than I am. And that's the thing, you can look at all these different models and everybody has their own ideas and their own inputs. So it's really hard to say who's right and who's wrong. It's kind of a guessing game sometimes, especially with these smaller companies. Let's look at the historical stock price and see where it's been trading. So 5 years ago it was trading at about $3 or a little more than $3, but it's been coming down ever since. And it's at a pretty low point at 49 cents. Yesterday it must have been around 32, 33 cents because it came up about 50% today. So it seems like there's an opportunity for growth, but there's a lot of risk in stocks like this. It could easily go bankrupt, these types of companies. Let's look at their financial ratios. They have a negative PE because their earnings per share is negative, because earnings per share is net income over shares outstanding, and their net income was negative 5 million. So you can't really look at the PE ratio. They have a price to sales ratio below 1, which is considered a really good value. That's price to stock over sales per share. And to get sales per share is revenue over shares outstanding. The price to book is 4.6, which is a little higher than what I like. That's price to stock over book value per share. And to get book value per share is equity over shares outstanding. Let's see their other ratios. Current ratio 1.0. So their current assets just cover their current liabilities, so that's okay. Negative ROE because they have negative income. The best way to look at ratios is to compare them to similar companies. I've done videos on Baker Hughes, Canadian Natural Resources, Diversified Gas and Oil, Denbury, Marathon Oil, Occidental Petroleum, Shorecore, Transatlantic, and Whitecap. So if Transatlantic has a number in red, they're worse than the average. If they're in green, they're better than the average. So the only thing they're better than the average in is in price to sales. They're at 0.5, which is a good ratio to be strong in. They're a really small company, only 35 million market cap. So they do have a lot of room to grow. This could be a really good long-term play, or it could be a bust. Who knows? Let me know what you think in the comments. Thanks for watching.